Hey everyone, Jared here. Are you buying a home or trying to refinance? Well, a lot of people think it's all about getting the best interest rate, and that's not always the case. Today, I'm going to show you why the interest rate is just the beginning and a small portion of what your total mortgage product is made out of. And we'll dive into the key features of a mortgage that actually save you a lot of money over the long run. These are features that most borrowers overlook. The first thing we're going to talk about is the rate trap and why interest rate isn't everything. Now, we all know that interest rate is a huge factor in choosing mortgage. It is the main component of what actually determines your monthly payment. But the thing is, it's oftentimes not the only thing that's going to save you the most amount of money. Most people don't actually take the time to do the calculation on how much difference in interest one interest rate gives them versus another. They oftentimes just look at the interest rate itself, and sometimes a rate of 0.1 or 0.2 difference actually sways someone's decision on what product they should choose. Meanwhile, that could only be a couple bucks a month, $10, $20, $30 a month, but they're sacrificing so many other features while doing that. Now, an example on why the interest rate isn't everything: statistics show that 60% of people break their mortgage between 3 and 5 years. And if you went into a mortgage product with a low interest rate but a high penalty, it doesn't matter if you're saving $20 or $30 a month when you're paying thousands of dollars more when you go to break it. And now, even to play devil's advocate, let's say you don't break it. Well, you're closing yourself off from those opportunities to refinance because your penalty is too high. So whatever way you look at it, you're closing yourself off from more savings in the future. The second thing I wanted to talk about is what is better between a fixed or a variable rate, because it's really going to depend on your unique situation. So typically, if you like stability and certainty, a fixed rate is going to be the way to go. It's by far the most popular choice of Canadians in 2024, with nearly 70% of people choosing a fixed rate mortgage. Now, that has to do mainly with interest rates shooting up over the past few years. It hasn't always been like that. It's usually an even split. But very recently, fixed rates have been the more popular choice, specifically a 3-year term, and we'll get into that later in the video. The downside to a fixed rate mortgage is that if interest rates come down, your rate is still locked where it is. So you are missing out on potential savings. On top of that, the penalty to get out of a fixed rate mortgage can be, and I say can be because it's calculated two ways. You either pay a 3-month interest penalty, or you pay what's called the interest rate differential. The interest rate differential is where you can see a massive penalty. Every bank is going to calculate this slightly different, but the main concept is the difference in interest between the rate you have and the rates currently on the market. Major banks and credit unions can be sneaky with this because they use their posted rates for this calculation, which are typically inflated compared to the rate that you actually have on your contract. This IRD, interest rate differential, is where you can see penalties in the tens of thousands, even on a smaller mortgage of $300,000 or $400,000. On the flip side, variable rates, on the other hand, they can be a bit of a gamble. And what I mean by this is they're controlled by the Bank of Canada prime rate. So you either have a Bank of Canada prime rate discount or a Bank of Canada prime rate surplus on your contract. This can oftentimes look like prime minus 0.5. That means wherever the Bank of Canada prime rate goes, you will always be 0.5% lower than that. It's very important to understand that this rate isn't just going to change randomly one day. There's 8 meetings every single year that the Bank of Canada has where they decide to increase, decrease, or keep prime rate exactly the same, and it's typically dependent on how the economy is doing. Therefore, if they decide to increase the Bank of Canada prime rate, your rate will also go up as well, and you're going to pay more interest. I won't dive too deep into the two different types of variable rate mortgages. All you need to know is that if the Bank of Canada prime rate increases, you're going to pay more interest, and if it decreases, you're going to pay less interest. The two different types of variable rate mortgages just determine whether your payment increases to account for that, or if your payment stays the same and you just start paying your mortgage down a little bit slower. But aside from that, the benefit to a variable rate mortgage is you're only ever going to make a 3-month interest penalty, unlike the fixed rate mortgage that had the interest rate differential penalty that can be in the tens of thousands. Third thing I want to discuss is amortization. So this is the life of your mortgage, how long it's actually going to take you to pay it down. Now, the most common choice is 25 years, and that typically was the only thing you could get, and that used to be the maximum amortization for insured mortgages with less than 20% down. However, those rules have changed for first-time homebuyers, and for new build properties, you can go up to 30 years on an insured mortgage, and conventional mortgages, which are more than 20% down, you've always been able to get a 30-year mortgage. Now, you might be wondering, well, why would someone want to take a 30-year mortgage? That just means they're paying their mortgage down slower, which obviously means they're just going to pay way more interest over their entire life. And you're not wrong for thinking that. But at the same time, having a longer amortization is going to make your monthly payment quite a bit lower. And there's a couple benefits. Obviously, your budget. If you're on a tight budget and you need a low monthly payment, a 30-year is going to be better than a 25-year. On top of that, because there's the lower monthly payment, you're actually going to qualify to borrow a little bit more money. And when I say a little bit, I mean 10, 20, 30, sometimes even $40,000 more just by taking a 30-year amortization rather than a 25-year. Now, I know I made the 30-year amortization sound like it's the obvious choice. Well, there must be some downside. And you're right for thinking that. Obviously, there's the downside that we just mentioned before, is that you're going to be paying your mortgage over a longer period of time, which means you're paying more interest. On top of that, most banks have a different interest rate for 25-year mortgages versus 30-year mortgages. Sometimes they don't, but oftentimes it's a 0.1% premium. It's a little bit more interest, but the overall payment might be lower and might suit your situation better. Okay, the fourth thing we're going to talk about is insured mortgages versus conventional mortgages. This is where a lot of people go wrong, especially if you're online searching for interest rates. Insured mortgages are going to have the lowest interest rate, and the reason why is you're paying a substantial insurance premium for the lender. So it's actually safer for the lender when you're putting less than 20% down because you're required to pay for this mortgage default insurance. This default insurance ranges from 2.8% all the way up to 4% of your entire mortgage amount, and it's one big lump sum that gets added into your mortgage. This is not an insurance that you can simply cancel when you sell your house. It's paid right up front by having it added into your mortgage. So for an example, if you were to buy a $500,000 home, you had $25,000 to put down, which is 5%, the minimum down payment, you would have a $475,000 mortgage. But then after getting that mortgage default insurance, you would have a $494,000 mortgage because there's going to be a $19,000 premium on that $475,000. Now, like I mentioned, insured mortgages, they do get a better interest rate. It's typically anywhere from 0.25% to even a full 0.5% lower than going conventional. But that doesn't matter because at the end of the day, I've never once seen a situation where you calculate the difference in interest and taking an insured mortgage and paying that premium ends up saving you more money than just going conventional with a higher rate and no insurance premium. Now, conventional mortgages are when you put 20% or more down, you are no longer needing that mortgage default insurance. You're simply getting a mortgage straight through the bank. Now, this is actually a bit riskier for the bank. Even though you're putting more down and their loan to value is lower, right at that 80% threshold is the riskiest it can get for a bank because they're not insured, and it's the maximum they'll lend without needing insurance. And so therefore they have different pricing for conventional mortgages. And this is what the majority of people go into, and it's usually about 0.25% to 0.5% higher. What you got to be careful with is when you go online and you search interest rates, oftentimes you're only ever looking at the insured rates. I mean, I'm sure you're not stupid, and you know when you go online, people are going to want to advertise their best stuff. Therefore, they're going to put their lowest rates out there, and in the fine print, it's going to say for insured mortgages only. Now, that's where people who are getting a conventional mortgage go wrong. They hear about all their friends getting a certain rate, and they think that they need to try to match that. And the fact of the matter is, you probably could match that if you went to a specific place. But what are you sacrificing on your conventional mortgage to get that same rate? The fifth thing we're going to discuss is prepayment penalties. We already briefly went into this, but it's very important to understand. Every bank calculates their penalties different, but there is a commonality between banks when it comes to penalties on fixed rates versus penalties on variable rates. Penalties on variable rates are always 3 months interest. Whatever your interest portion is of your monthly payment, times that by 3, that is your penalty to get out. A fixed rate mortgage is always going to go based off of the higher amount of either the 3-month interest penalty or the interest rate differential. They calculate both of them, they see which one's higher, and they make you pay that. So bare minimum, you're always going to pay 3-month interest on a fixed rate, but it's very likely you'll end up paying substantially more with their interest rate differential calculation. This is where every bank calculates their interest rate differential differently. Some use the actual rate on your contract compared to the new rates. Some use the posted rates at the time that you sign on. Some use your contract rate plus 1% compared to the current rates. There's many different ways that banks calculate this, and that can be a big factor in how much you're going to pay if you were to refinance. Banks also have what's called prepayment privileges, and this is how much you can put towards your mortgage without triggering a penalty. This is oftentimes in the form of a lump sum, but also can be just allowing you to increase your monthly payment, and the entire extra amount you put towards your payment also goes towards paying down your loan. There are banks with very flexible terms that allow both lump sums and increased payments, and having these privileges are more important than you think. Oftentimes when I discuss these prepayment privileges with clients, it's not really a main factor for them, because at the end of the day, if they were to try to use up all those privileges, there's no way. They don't make enough money. For an example, as of right now, when I'm recording this video, you can make a 20% lump sum towards your mortgage with Scotiabank, and you're also allowed to increase your payment up to double. You can stack those two privileges together. So you could imagine if you're getting a $500,000 mortgage, you're allowed to put $100,000 per year towards that mortgage. Obviously, it would get lower because it's a percentage. And on top of that, you're allowed to double your payment. I don't know about you, but if I was getting a $500,000 mortgage, it's very unlikely that I would just have $100,000 to throw at my mortgage every single year. Now, what people do often overlook is that these privileges can be very handy in lowering your mortgage balance right before breaking it. Oftentimes, I've had clients where they have 20% lump sum privileges, they're allowed to double their payment, and they know that they're going to be breaking their mortgage in a couple months. Sometimes they even ask family if they can quickly borrow that money. Family transfers the money over, they lower the mortgage amount, and then they break the mortgage. Therefore, their penalty is being calculated on a much lower balance than it was before. And the last thing I want to talk about, number 6, is portability, but also special features like readvanceable line of credits. So portability means you can bring that mortgage where you currently are living to the new home when you go to the new home. And this can be very important because it's going to stop you from having to pay a penalty. And as you have just heard in this video, that can be quite substantial. Now, I truly believe making sure your mortgage is portable is very, very important. When you go to buy a new home, it's very, very important that you can bring that mortgage with you to the new place. There definitely are situations where you wouldn't want to port a mortgage, simply if rates were better at the time, or maybe you're downsizing and you're taking a much smaller mortgage amount. Those are situations where it might not make sense to port it, but always having that option is important, because let's say that you got this kick-ass interest rate with one of the banks on a 5-year fixed term, and you're 2.5 years in and you decide you need more space, your family's growing, you want to go to a new home, you want to be able to bring that 2.5–3% mortgage rate with you. Not have to break it, pay a penalty, and get a new mortgage at a much higher rate. Having that be portable is so important. And this is where you need to be working with your mortgage broker to ensure that your mortgage product that you are choosing can actually be moved from one property to the next. And I briefly mentioned special features. A lot of mortgages on the conventional side nowadays with major banks have what's called a readvanceable home equity line of credit built in. A home equity line of credit is just like a normal line of credit that you would have. However, it's attached to your house. And the reason why that makes a difference is it makes a difference with the interest rate and the total limit. Typically, these limits are quite high. Now, what a readvanceable line of credit is, it means all the money used to pay down your mortgage, that money then becomes available in your line of credit. So let's say you put $10,000 towards your mortgage, well, you would have a $10,000 higher limit on your line of credit. And this could be a great tool for investing, if you want to buy additional properties, renovations, really whatever. Anytime you need to access your equity, having one of these readvanceable line of credits can save you a lot of money, because then you don't need to go attach a home equity line of credit in the future, which has some legal fees involved. And on top of that, you don't have to borrow the money through your line of credit or credit cards potentially. And this is going to be a much lower interest rate. So that alone does make a difference. And if you're choosing between a product that's 0.1 or 0.2% lower versus one that has a readvanceable line of credit, it's very likely the one with the readvanceable line of credit will actually save you more money in the long run by not having to add a HELOC in the future or not having to pay for other stuff on lines of credits or credit cards that are unsecured. And there you have it. We covered interest rate, fixed versus variable, conventional versus insured, if your mortgage is portable, how the penalties and prepayment privileges work, and portability. And those are all things that you really need to be considering when choosing your mortgage product. Don't be the person that just looks at the lowest interest rate. Trust me, I understand interest rates is important. It's what makes up your total monthly payment. But do the math. Actually see how much that 0.1 or 0.2% is actually saving you, and is that savings worth sacrificing all the additional features that you could have by choosing a more flexible mortgage? Now, if you were to walk into any bank, specifically the bank you bank with, it's important to understand that they don't care to advise you on what product is actually best for you. They don't go through these different aspects. Their products might be good in one way, but bad in the other. And that's why it's so important you're working with a mortgage broker to help you make this decision. My name's Jarrett White once again, and I run a mortgage company called White Ridge Mortgage in BC, Canada. If you're in the process of doing your mortgage renewal, maybe you're refinancing, or even just buying your first home, you can reach out to us. We can have a chat. We can make sure that you're making an educated decision on the mortgage product you're choosing, and we're 100% free to work with. I'll put a link in the description if you want to book a call. And thank you guys so much for watching. If you could, please hit that like button, ring the bell to be notified, and subscribe to the channel. It really does make a big difference for me. It encourages me to make more videos just like this one and keep pumping out this mortgage content so people could be better educated when choosing a mortgage product. Lastly, thanks again for sticking around through the entire video and watching, and I hope to catch you on the next one.